This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. So navigating retirement plans as a small business owner can be challenging. There are these different plans. There's 401ks, there's simple IRAs, SEP IRAs, solo 401ks, and defined benefit designs, and all kinds of options. And there's compliance to worry about. And employees like to have these plans. And so I'm really excited to be joined by today's guest. I don't think I've done an episode on retirement plans and everything that small business owners need to know about retirement plans. Everything might be overstating it, but we're going to cover some of the more important topics today with our guest. And so I'm really happy to welcome Charles Reichelt to the show. Welcome, Charles.
Yeah. Thank you, Cal. Appreciate it. Appreciate the invitation. I'm happy to be here. I'm excited to take part in this podcast and share some information.
So, you know, I guess first of all, from your perspective, and you advise clients on this, and we can get into what more specifically you do later, but why are company retirement plans important in the small business space, do you think?
A couple reasons. I'd say the first main reason is when you look at it through the owner's lens, it's about a tax deduction first and foremost. If a business is profitable and they're paying taxes, a any kind of retirement plan will help the business owner reduce their tax load or their tax burden. So I'd say that's number one. Number two, though, is to start to build wealth through the actual business itself. So owners like to take some of those revenue streams and start to build the wealth that's needed for them to create a legacy and move on down the road, potentially sell their business or however they want to dispose of it. And then for the employees, it's a big retention tool. I can't tell you how many employers I've spoken to that they lose employees over the fact that they don't have a retirement plan, and someone walked down the street for an extra dollar an hour and a 401k plan that offered a match. So I'd say for retention purposes, it's the number two benefit behind healthcare benefits that employees look for. And I'll say maybe even number one now because employees can purchase healthcare insurance on their own through an exchange. And so that's, the need for small business owners to always offer healthcare is not necessarily always there, but a 401k retirement plan is by far, I think, something that employees look to have when they're evaluating where they're going to work.
And so you spent the first part of your career largely doing wholesale of retirement plans, right? So kind of
That's
how
correct.
did that work? And what's the difference between that and what you're doing now?
Yeah, great question. So as a wholesaler, I used to basically sell a retirement product or platform through a third party, and that third party was always a financial advisor. Financial advisor would introduce me to their clients, and I would present our solution at the time, whoever I was representing, to that client, and had a wonderful sales career. And really, for me, it just got to the point, Cal, where I am 58 years old and didn't want to have a goal every year that the business said I had to achieve. So I had some pretty lofty goals each and every year, and I wanted to move away from that. So I created this company called FTG Squared, and I focus just on the 401k market itself. I'm an advisor to 401k plans, and I'm filling a lot of the holes that I saw as a wholesaler, especially when it comes to the small business market. And I define that as, call it, solo person up to 50 employees. What I saw was a lot of gaps in service. Advisors didn't necessarily want to service that level of business. And so I've created a very easy approach, a 5-step approach to helping businesses get what they want. And that's to reduce taxes, build wealth, and not spend a lot of time doing it.
Right.
So that's the big difference, is that now I'm working directly with business owners and calling directly on those that would actually have the need for something like a retirement plan.
And what were some of those gaps that you're now filling as a direct consultant?
Well, one of the first gaps is just helping business owners navigate just the technicalities of these plans. Give you a quick example. A lot of times I saw where business owners missed out on deductions because they didn't have a support system to allow them to get investments in the plan. So I will actually integrate myself with the business's payroll, meaning I'll work directly with their payroll provider to make sure that business owner gets their deduction in the plan for that year. Second thing I'll do is meet individually with each employee. And actually, I like to say I meet the employee where they're at today. And I want to build a relationship with them. And if the plan is appropriate for them, I will help them get involved with that program and get them in at the right level and invested in the right way inside the program. That's something that's very uncommon in the business. I like to do one-on-ones. If the employer will let me, I'll do one-on-ones either virtually, like we are discussing today, or one-on-ones face-to-face. And I've had a great success in getting employees into plans. I have over a 90% participation rate, and so that's something that you did not see, or I did not see in the marketplace.
That is unusual because I talk to other folks who are trying to do something similar. They're interested in, 100 plus employee plans where they can make a lot of money. They're not
Yep.
talking about enjoying sitting down with the employees of a 10 employee company and helping them like you are.
I actually really enjoy it. I Why do I enjoy it? I enjoy it because I got some great advice as a young person. And that advice was to stick 10% in a plan. And, this was my mentor, right? My mentor said, "You're going to do this." And I did it, right? I just trusted her and I put the money in the plan. And it really allowed me it set me up for my financial future by doing that. And so I want to just impart some of that good wisdom to people so that they can do the same thing. It's not as hard as we all think it is. Sometimes people feel like it's complex. And if you have somebody there guiding you and helping you and answering your questions, that's the other thing, Cal. A lot of people don't like to ask questions in a group setting, right? It's personal. It's personal to them, and they got to be able to trust you too. So doing those one-on-ones really opens the door for that, and allows me to give what I call conflict-free advice.
Right. So in terms of these different plan types, we kind of use 401k as the umbrella term for
Yes.
retirement plans that employees participate in.
Yeah.
But so maybe we'll start with the 401k as a structure and then move on to some of the alternatives. But
Sure.
kind of what's the 401k plan structure and like pros and cons of the 401k structure?
Yeah. If you mind, I'll just use an analogy that I've always used to explain these plans. I consider the 401k plan the Accord of the marketplace, a Honda Accord. Um, I own a Honda Accord, and and they're very reliable. They get you down the road, and a lot of times they'll get you where you want to go. And so that's really how I view a 401k plan. It's all reliable. It provides a business owner the ability to next year put away $24,000 from their pay. It allows for different matching scenarios depending on what the business owner is looking to do from an employer contribution standpoint. And it also allows flexibility for profit sharing. And so if you add that profit sharing component to a 401k, now you're moving from an Accord, usually up to a BMW, right? So what I mean by that is profit sharing component for an employer and an owner will allow them to save more, in many cases up to $70,000 to $80,000 a year inside one plan. And if that is your objective as a business owner, and also let's just say it's your accountant's objective for you, then you can step up to this BMW by, basically just bolting on a profit sharing formula or profit sharing provision to the plan. If I downshift a little bit and I'll talk about the Civic, and that's a simple IRA. You know, Civic, I think, was ranked the number one sales car in last year in 2024, 2025. And so with the Civic, the simple will allow, $16,000 to $17,000 for a business owner to set aside. In many cases, a simple is just fine for a small business. But the thing with the simple is it provides no flexibility. And so, you're stuck with essentially this matching component which is a dollar for dollar up to 3%. And it's very kind of hard and fast rules. So I see a lot of people starting out many times with the simple, at the Civic, and then upgrading to an Accord, and from there maybe into the BMW with a profit sharing feature.
Yeah, I've worked with both simple IRA plan structures and 401ks. Um, I will say the 401k, it's complicated. You have an annual Form 5500, you have compliance,
Yep.
testing. You kind of have to know what you're really doing or have an advisor or a CFO or somebody who stays on top of all that for you.
Yes.
Whereas the simple, you just kind of sign up, the employees own their own accounts at the fund company, you kind of go through the motions and you've got a retirement plan that doesn't, take a lot of time to manage.
That is correct. There is a complexity to a 401k that is not there as part of a simple plan, and so that is one. If you're really looking for no fuss, no muss, and high deductions aren't that important to you as a business owner, then the simple's usually a great solution. Um, but the second you want to start putting more away, you kind of got to deal with that complexity, and that's kind of where I can step in and be a resource to people and helping them figure out what's the right design.
Right. And then I hear about other plans, a SEP IRA and a solo 401k, for example. What are those about?
So I'll just give you my opinion there. So SEP IRA and a solo K are pretty similar, with one big difference, and that is that a solo K will allow an entrepreneur, a solopreneur, to essentially not worry about what the compensation level is going to be and still deduct the full $24,000 into the plan. See, with the SEP, in a SEP, they are subject to a 25% income limit. And so with a 25% income limit, if the accountant is keeping the business owner's income at say $60 to $70,000, it really doesn't give the business owner the biggest bang for their buck. In a solo K, you can set these up very quickly, very easily, and allow that business owner, even if you're going to pay them 60 to 70,000, allow that business owner to deduct the full 24,000. That's the flexibility. I set up very few SEP IRAs. I set up a lot of solo Ks.
Okay.
Um, you can get a solo K now as low as, I don't know, 250 to $300 a year for cost. And so that little bit of cost adds another $10,000 in many cases to a deduction that the business owner is allowed to have. And so that's why I typically will suggest a solo versus a SEP.
Okay. And then are there other somewhat common plan design types that we should cover?
The only one we haven't discussed is the cash balance plan. And if we go back to um, my car analogy, it would be like I don't know, what's the highest level car you can buy these days? A Porsche, something like that. And the cash balance is for cash rich, high deductible kind of companies that want a huge tax deduction. And so you pair a cash balance with a 401k, and that allows a business owner to deduct an additional six-figure amount into a plan. Now, these are very specialized. You really have to pay attention to what you're doing, and they're not for everybody. But if you have a high tax need, you're going to be able to pay, a six-figure, contribution into a plan year in and year out for the next 5 to 6 years. Then a cash balance plan might be something that is valuable to you and something that is welcome. I will not. I will only set up a cash balance plan with the I'll say the blessing of the accountant. You have to involve your accountant in this decision. You don't want to just go it alone and decide, yeah, this sounds great. I can save hundreds of thousands of dollars in taxes, but you got to have the cash to be able to do it. And so that's where I seek counsel of the client's accountant.
And then on the other side, we've been talking about how much the business owner is allowed to contribute to these kinds of plans or have the company contribute some kind of a match or profit sharing contribution for the business owner. But on the other side, you know, all these great benefits to the crew to the business owner from participating in these plans. if the employees are in there getting similar levels of benefits, it can be very expensive, and you have to think about, if the employer wants to maximize their contribution rates, what do they need to do to avoid failing discrimination tests for the employees? Or a simple IRA makes it pretty straightforward, but
Yep,
once you get into
that's
these more
true.
complicated structures, if you want to do profit sharing or maxes, you're going to owe it to some employees who participate, maybe even some who don't participate actively, right? So you really
Right.
got to work with somebody like you who knows what the business has to do for all of the employees to stay in compliance, because the problems of being out of compliance can end up being pretty big.
Correct. So, Cal, how I address that with employers is I ask a lot of questions up front. And when it comes to designing a plan from scratch for small businesses, one of the things you want to do is help that small business owner budget what that's going to cost, right? It's a pretty easy formula because if you use, you know, the highest level of participation, you can tell a business owner what they're going to essentially owe into a plan. So when I set up plans these days, I set up very few non-safe harbor plans. I have them, right? But the advantage of a safe harbor plan is that you bypass a lot of the complexity of a 401k plan. So most businesses these days establish a safe harbor plan out of the gate. And I make sure as part of my due diligence with the business owner to number one, point out how much this is going to potentially cost from an employer contribution strategy. And then what are the benefits that come back to them? And one of the biggest benefits that it really doesn't get a lot of press are these new tax credits that are available to small businesses. You can establish a plan today, and you can get back $1,000 in match for every employee that participates in your plan that you pay for that is compensated less than $100,000. So, if I make say $60,000 a year at a company, and let's say I put in, I don't know, 4% of that amount as an employee, that's $2,400. And if I'm matching that, I get a credit of $1,000 on that 2,400, right? So I put in 2,400, but at the end of the year, I'm going to get $1,000 credit to help me as a business owner offset the cost of this plan. So when you show people like, okay, yeah, it's going to cost you this much to put this plan in place, but here's what you're going to receive uh, come tax time, it makes it in many cases a lot more affordable. And by the way, this applies to simples too. So, if whether you install a simple or whether you install a 401k, you still get these tax credits, and it's up to $1,000 per employee that makes less than $100,000.
Hmm. And if you already have one of these plans, when you open up a different type of plan, you still get that tax credit?
You do. So there's three tax credits. There's the pure startup credit, there's the automatic enrollment credit, and then there's this employer matching credit that I've been talking about. And let's say you have a simple plan and you can convert to a 401k, you will get 4 out of the 5 years of the matching credit. And so what I talk to employers about if they have a simple plan, and especially if they want to sort of step it up, is for essentially the same cost or similar levels of cost that you're putting into the simple plan, you can now have the government help you pay for a portion of that 4 out of the 5 years. And so that's a big advantage that wasn't there for, hate to date myself, but for a long time when it was trying to start a plan, it was all about cost, right? That was all it was ever about. And if you were talking about a simple or 401k, that was it, right? And so nowadays, yes, cost is a factor 100%, but now you have this government piece that will really help you, and it's a pure credit. It's right off the bottom line.
Wow. Okay. So let's go through some scenarios and what types of plans generally make sense to consider in those scenarios. So let's say
Sure.
I'm a solopreneur, I'm a consultant, I make pretty good money. I'm not really planning to hire other W-2 employees anytime soon.
Yep.
What should I really be looking at?
Solo K. Don't look at anything else. I'm going
Okay.
to save you a lot of time. Don't look at a SEP. Look at a solo K. Find a provider that will provide a document for you at a very low cost. You don't have to have a filing until you reach $250,000 in assets, so you don't need to worry about your 5,500 for a while. Definitely get a solo K because it's going to provide you a lot more flexibility than a SEP will.
Okay. And say I'm, a very small business with less than 5 employees, kind of 2 to 5 employees, not trying to conquer the world, looking for slow and steady growth, never going to get big. Nice little business, who wants to implement a retirement plan. What are the good plans to consider?
So I would say for that group, just out of the gate, without doing any consulting, I'd say the simple IRA would be the appropriate choice, just to start. But if I, in my investigations, if I find out that the business owner is making in excess of 150,000 or 200,000, then I might change my suggestion to a 401k, because the 401k is going to allow a higher level of deduction. And there's a lot of fintech companies out there that have products and services that are available. Not a huge fan of them, Cal, but they are great starter plans, right? And they will get they will get you to a certain point, and then as an advisor, I'll help you navigate to something else 3, 4, 5 years down the road. Um, just to name a few, Vestwell's a good one, I think. Who else? Gusto Payroll, right? Gusto slash Guideline. I've set some people up on those plans. Easy to administer, but it's not going to be for the long term. Once we get a certain level of assets under management, we'll start. I'll look at other alternatives for them. But great starter plans, low cost, easy. So simple IRA, if it's going to just be, if someone's making less than 150,000, an owner is making less than 150,000, probably a 401k if you're making over 150,000.
Okay. Unless I'm a little bit bigger, I'm still not going to conquer the world, but I'm like, you know, 10, 15, 20 employees and looking to, grow slow and steady there.
Yep.
Same kind of answers the previous question, but more likely the 401k might make sense.
Here's why I think the 401k makes sense. It's yes, it's important for the business owner, but it's also a legitimate plan, and people look at it like that, right? Employees say, "Oh, I got a 401k." And I know it doesn't seem to make much difference, simple IRA versus a 401k, but it does to some employees. They for lack of a better word, they understand the 401k better. Why? Because they pick up the paper. I guess people don't pick up the paper anymore. They go online and they read about 401ks, right? They don't read about simple IRAs. So it is a legitimate plan. And if you're, 15 to 20 employees, you want a legitimate plan. You want something that's going to allow people to say, okay, I'm in a 401k. This company is going concern, going to be around a long time. And I got a legitimate benefit here.
Right. You could probably have, a little bit more money and time to manage the 401k if you're at that scale, hopefully.
100%. I've started a bunch, and, um, you know, they grow very quickly, especially in this current market environment. I'm not going to say that this market environment is going to live around forever, but right now it's been a very positive thing for employers and employees.
Cool. And let's say I've got, a larger business. I've got like 50 employees and I'm looking to grow it to 100 plus and, grow into the mid market and see how big I can take this thing. I assume you're
Yep.
going to tell me 401k plus maybe some bells and whistles depending on the business owner.
I'm just going to tell you 401k.
Yeah. All right.
Because I mean it's just the way of the world.
Okay.
Um, Now I will caveat that and say if it's a C corp, right? Then the business owner can add something called a non-qualified plan, right? And so that's definitely a consideration if the business is structured as a C corp. And if that's the case, then you can put a 401k in place, and then you can put a companion non-qualified plan in place for the business owner, and it won't cost them an arm and a leg. They don't non-qualified plan. They don't have to follow all the rules of a 401k.
Okay. So sounds like the most prominent options would be solo 401k, if you're a solopreneur, simple IRA if you're a really small business and don't want the hassles and complications of a 401k, or 401k if you're becoming,
401k.
yeah, okay. There we go. Three options then, for the most part.
Today, this it's always could change, but today that's your options.
Okay. Um, and I know one of the things we spoke about last week or whenever was, the challenge in balancing low cost plans to benefit the employees so they're not spending too much of their retirement savings on plan administration and advisor fees, um, versus access to an advisor like you who somehow needs to get paid, right?
Yep,
And so,
correct.
in my experience, either you get no real advisory, but you can get into low cost ETFs with 10 basis point cost ratios, and you pay in maybe 25 or $50 a year per employee, and it's ultra low cost, but you don't get a lot other than a plan.
Yep,
Or you can get an advisor who'll offer to help you and meet with your employees, and you end up between the advisor or higher cost mutual fund options. Employees could be paying 1.5% a year
hmm
of their plan in expenses to the fund company. And when the market
yep,
keeps going up 10 or 20% a year, nobody really notices that. But if we get back to the markets that go down or go flat for a while, then that can really eat into the return. So a business owner who's looking out for their employees wants them to have access to ultra low cost plans. But a
yep.
business owner who wants the employees to have access to good financial advisory may not want to spring, for a ton of money. So how do you balance those two conflicting interests at your business?
That's a great question, Cal. So, coming from that background, I know, as an advisor, you can charge whatever the heck you want, whatever the market will bear, quote unquote. And so, one thing I did look to change in this business is the way fees are assessed. And so I created a very simple 5-step process that if somebody wants to engage me with, I can provide a very low cost approach, both to them, both to the employer and to the employee. And what I mean by that is I will chart, like, I'll just use me as an example, right? The average going rate in a retirement plan these days is 0.5% that you would pay to an advisor. Okay. That's the normal amount. I I don't charge that. I charge 0.25% for my plans. So I'm giving back already point I'm giving back to the employees, right? Because that's usually taken from their accounts. And then I charge a very nominal monthly cost of $90 a month to cover my expenses and to provide access to me at any given time. So everybody I work with has my phone number, has my email, and they when they call me, I'm accessible and I can answer their questions very quickly and very easily. So I think I've created a new way of doing this, and at least different from how I worked with other advisors in the past. And so this combination of an out of pocket monthly cost, access to me and my process, and then 0.25% to the employees. Normally, Cal, I can get to about 1 to 1.1% all in for an employee. And if you can get, and this is a startup plan, right? Now, so most startup plans cost 2 to 3% when you start adding all the stuff in there. So I shop the market, make sure I provide the best benefit. We make a selection together as to what's appropriate, and then I'm very transparent about what our costs are. And so, outlining all of that to employers and making sure that it's affordable for them. Because that's the other thing, right? You got to be able to afford these things. Doesn't do any good to offer something in the marketplace that's appropriate for somebody, by the way, if they can't afford it.
And you don't have, 8 layers of staff and management to cover either, right?
That's correct.
Keep your cost structure lean and mean. You can pass through some of that savings to clients.
That's correct. I run a very lean organization here, um, and it's it's time. There's a lot of time commitment in setting up a plan. It's typically minimum 8 to 16 hours, depending on how many employees are involved. I'm doing one right now. I've got a 50 employee school that I'm doing, and I've spent, gosh, at least 3 full days there, right, meeting with everybody one on one. So there's a time component to that, but once you get things rocking and rolling, and once you get the plan up and running for people, then it becomes, hey, whenever they need me, they can call me and I can respond, make sure that everybody's doing what they're supposed to be doing. One annual meeting a year with the employer, one annual meeting a year with the employees, and then that takes care of itself. So, yes, a lot of work to get started, but as time goes on, not as much work, right? And so that's how you can balance it and be lean and mean, and still provide a high level of service.
So you mentioned a couple things how you work with clients. I think you mentioned a five-step process and maybe something else. Could you explain what those mean or what the approach
Sure.
is?
Yeah. So I call it call your own shot process, the 5-step process. And the first step is clarity, right? We get some clarity as to which way we're going to go. What are the objectives? Why are we establishing this plan? Then the second step is I go away and I do my research and we come back and we collaborate and we'll select a vendor that we're going to work with. Then third step is execution, right? Documents, data, you name it, education. I do all of that work for the client, right? I try to, if they give me access to their payroll, I'll do all the heavy lifting to essentially get that moving forward. And then, what do people really, need? They need somebody who's going to be there and be their advocate for them. So that's step 4. I provide that advocacy and then I deliver on what they want, right? And what they want is reduction in taxes, building wealth, and they don't want to spend any time on it. So that's the 5-step program. I call it call your own shots. I do have help. The other thing I have done, Cal, is I do have individual consulting arrangements where I've come in and I've diagnosed issues with plans, and the client just wants to pay me as from a consulting perspective, and I'll depending on how they want to operate, I'll either charge them an hourly fee to do that. I'll charge them some points on their assets if that's how they want to build, pay me, or we'll come up with a project cost, right? And those are for, I'll say, ad hoc, solutions that people are looking for, right? And so I've done a couple of those, and I'm happy to work with anybody in any capacity, right? But if you the 5-step process, the call your own shots, that's what I've created and developed over the last year.
Okay. Yeah, that's interesting because, if we already have if I'm a business owner and I already have a plan and I don't know if I need a new plan or change plan, I don't want to sign up to switch vendors. Like, I just want somebody
Yep,
to come in and review what I have and advise me, right? So they can get
you
that
got
from
it.
you. And then you can decide,
Absolutely.
does it make sense to switch plans and get into a long-term engagement?
You got it. You
Okay.
got it.
Okay.
Absolutely. Yeah, people, some people already have good relationships with their provider. They already have good relationships with the people. But what I found is a lot of times these plans are set up, I hate to say it, with a paper napkin, like, hey, the initial call comes in and says, I need to create a retirement plan, and it just happens, but there's not necessarily any objectives behind it, any rationale behind it. And so, I can come in and kind of figure out, based again on these discussions with employers, what's going to be the best fit. And then if they want me to be the advisor, great. If they don't, that's fine too. And I can serve the community either way.
So when you're reviewing plans, or business owners are thinking about, you know, um, what they have now, what are some signs or symptoms that the business owner should reevaluate their retirement plan?
So first is benchmarking, right? So the first thing is are your employees actually participating in the plan, right? So what's the participation rate? What's the deferral rate? Are people? What I mean by deferral rate is what's the average contribution rate by each employee? What's the return of that plan? Globally, how is the plan? And that just, Cal, that speaks to where the money's invested, right? Not necessarily if the investments are poor. It speaks to the education that employees have received and where they've put their money. And so, return, participation rate, contribution rate, all of those things are very important when you're benchmarking a plan, right? Second thing is the actual investments themselves. Do they pass the fiduciary smell test, right? Here's what I tell you: most of them do. Most investments are fine, right? There's not like you're not going to come across a lot of poor investments these days, but it's really about procedural prudence. And do you have something set up where you're reviewing this and then you're documenting it each and every year. That's the step that a lot of people miss, is the procedural prudence. So helping them establish that. Third is actually to look at the design of the plan. How's the actual design look? Is the eligibility correct? Is Are the employer contributions set up in such a way to benefit your highest valued employee, right? So I take a deep dive into the design and offer suggestions, as to how things can be improved. um, Cost is obviously something that everybody is interested about. So benchmarking the cost, is the cost in line with the marketplace and the size of the current plan? And is there room for efficiency on the cost side? You know, and then last but not least, efficiency. Is your plan situated and efficient enough to basically something that you can walk away from, in a sense, and not have to monitor on a daily basis? So there's been a big evolution here, Cal, in regards to services that are provided. And there's some concierge services out there now. You pay for it, right? Obviously, but there's some concierge services out there now that will take all the burden off the client's shoulders. So is that something that's wanted? Is that something that's needed? Um, One client I just recently helped, going into it, we didn't really know what the situation was, but plan design was a little disjointed. They had employees that became eligible for the 401k and then the matching at different times, and it was creating a disconnect for the employee. So we solved that. The investments, they didn't realize it, but the investments were very proprietary based. So they were all part of a company's own set of funds. And just in this case, this was a situation where they were expensive and they weren't really high performers, right? So we made a change to that. And then from an education standpoint, they didn't have anybody participating. So the education piece helped take care of all of that. So sometimes it's a whole revamp like that, right? That's needed. And you do it just in little pieces, bite-sized pieces, so that nobody ever feels, overwhelmed, right?
Yeah. So kind of what I'm hearing net of all that is, if I'm a business owner and it's been several years since I critically assessed my plan, I don't really know what I don't know, and I probably need to have it reviewed by somebody like you. Even if I don't know
Yes.
specifically there's a problem or specifically something I can't take advantage of. If it's not
Yep.
something I've looked at closely in a few years, maybe time to take a close look this year.
That's good advice. That was a similar situation here. They put this plan in place 7 years ago, and they hadn't even looked at it. I mean, literally hadn't looked at it. And I was referred into the business, and we had multiple conversations before they brought me on board. I met with the committee and all the partners and everything, but it was a big. They had a lot of things that needed improvement. In fact, I said, as part of the presentation, I said, "Look, my goal is to keep you right where you are, right where you're at today. I don't want to change your current situation. I just want to come in. I want to improve these areas. That's what you're hiring me to do." But when I got into it, like, I couldn't not show them where they could go with their plan and save over 50% of what they were paying. So, I actually came to him and I said, "Guys, I know I told you we were going to just leave this as is, and we can, but here's these other three options that are available to you. And, if I'm in your shoes, I would do it because the savings and the quality is so much better." Right. And so we actually just completed the process, a couple weeks ago, right? So we're all set and done. But that's a perfect case of not knowing what you don't know, right? And not having not looking at it, not having anybody reviewing it with you.
So what are your goals for your own business, FTG Squared?
Great question. My goal is to, grow at a clip of about 10. I want to acquire anywhere from 10 to 20 clients every year. Ultimately, I want to have about 100 clients. In that I'm helping, that I'm serving over time. And then my other thing is, what I think another unique aspect is I give back to the community. So FTG squared stands for the greater good. And the idea there is you're doing good for yourself if you invest in a retirement plan. But I take it a little step further, and then I give a portion, I give 5% of my revenue to a not for profit that assists with rebuilding neighborhoods here in our beautiful city of Baltimore, Maryland. And so I have an impact ticker in my that I keep track of, and ultimately I want to impact about 1,000 lives, 1,000 employees over time, and I might actually increase that to 2,000 because this year alone I've already impacted 83 people, and that may not seem like a lot, but if you can get somebody to invest in a plan at a young age, right? So that's one of my things. Never invested in a plan. They're going to do it for the first time. That's an impact. And then the second impact I track is, okay, you're only putting in 1% of your pay or 2% of your pay, and you need to do 5, 6%, right? Helping an employee increase that amount to a more sustainable level, that's also an impact. So this year alone, and I'm not done with the year yet, it's 83 people, right? So that's big, right? That's 83 people's lives that are potentially changed for the better. Because again, if you set these plans up and you start to contribute, and I'm there to help them every year to say, all right, here's what we're doing. Here's what you've done. How do you feel about this? Oh, can you do 1% more next year? And let's say they can afford it. It just puts them on a path where they'll start to build wealth, right? And last time I checked, the only way to build wealth in this country is to be in a plan. I mean, yes, you can get an inheritance from somebody. Maybe that's out there for you. Yes, you might be somebody who can develop a product that wants to be sold to millions of people, and you can, that could be something that you do. Or third, you win the lottery, right? All of those things are hard to do, like super hard. But this is easy, just getting in a plan. And so that's how you build wealth in America, is one little contribution at a time. And I want to be there to help them do it.
Right. And it is, I think it's important to, like what you're doing, educating employees on the contribution rates that they need in order to accumulate the kind of money for retirement that they'd like to have. Because when we do the math, like contributing the minimum to get your employer max, contributing 3 or 4% a year and getting a 3% max isn't going to get you a big retirement nest egg, right? And you
Nope.
got to start young so you get the benefits of compounding over the decades. I mean, you can do catch up contributions in your 50s, I guess, but it's a lot better to put that money in your 20s and your 30s.
100%. I mean, 100%. And the sooner, I show people a very modest future value calculation. I use a 7% return, right? So nothing extravagant. And I even show them starting out today and not even increasing that amount, right? So, all right, we're going to put this amount today in, and depending on your age, again, and depending on how long you have to retirement, that time in the market is a huge, huge factor. And so people are blown away when they see the numbers, right? And it's all sustainable. It's all something that can happen. It's just you gotta take that leap. You got to do it. And I love helping people do that. I love helping people get to that point.
It'll be interesting to see whether these new $1,000 Trump accounts impact young people's savings because they could turn 18 or 20 years old and have the benefit of 18 to 20 years of compounding the initial investment and realize, wow, if I just keep contributing money in my 20s, I'm going to end up with a lot of money when I'm at retirement age. We'll see.
Yep.
We'll see.
We'll say absolutely. Yeah. More to come, right? For sure.
Yeah.
Like,
And then you get like Michael Dell and his wife contributing like $6 billion or something to help fund similar type accounts. So it's interesting. We get young people into the investment game a couple decades earlier than they otherwise would be.
yeah, 100%. I mean, and I'm all for innovation in the marketplace. I mean, we've been dealing with the 401k simples for a long, long time, right? It's basically been, that's what we have, right? If somebody can come up with a better mousetrap, I'm all for it. you
Yeah.
know? And so I'd love to see innovation in this marketplace, because right now it's really just about getting in the plan and getting started and being in a diversified portfolio. But if there's something better out there, I'd love to see it. I'd love to see somebody come up with it.
Yeah. Yeah. Are there any other topics that small business owners really need to know about retirement plans that we haven't talked about yet?
Um, not necessarily, Cal. I think we've covered a really like a large swath of those today. I just would say that the one thing to be aware of is just employee overall general wellness, right? And one of the trends that I see, and one of my follow up items as I get to know employees, is to talk about home ownership. And home ownership is the second, call it the second tier to building wealth in America. And home ownership is hard. That's not an easy thing, right? It's easy to push a button and say I want to be in a 401k, but it's hard to own a home and the expectations around owning a home. And so what I've seen recently is a lot of incentive programs to help people get into homes. And so that's one thing business owners, if I was aware of, I would, you know, try to help your employees, if they can afford it, to link up with realtors that really know and understand the local laws of your area, and understand that there's now these big benefits in many cases for employees that want to take a 6 week course on owning a home and what that entails. Because the sooner they get into a home and start to build equity, it's just like the 401k, right? And over time, the more and more equity you build up, the more you're building wealth, the more you're creating it from scratch. And so that's usually the second step in my process is with employees, as I get to know them better, I'll ask about home ownership. If they're happy renting and they're all good, no problem. Keep doing it. But there are a lot of people out there that want to be in a home, but they just don't know how to get there. And so I link them up. I can link them up with various real estate personnel that really know and understand the market. I'd say that's the next thing that's really needed in this country, is to help people get into homes again. Right? We have a lot of you and I don't want to date you too much, but we had the ability to get into those homes at younger ages, and they were relatively affordable, right? Nowadays, different story, and it's a lot harder for people to get into a home. And so that would be the thing I'd suggest, is like looking beyond just this retirement plan and helping your employees get into homes. Be a
Yeah.
big difference.
Yeah. It's interesting on that topic. There's a lot in the news about how the home ownership rate is relatively low now compared to decades ago. And some people say, well, that's just because inflation's been too high, real estate prices are just too high, employee wages haven't kept up, and things like that. But the other side of it is the average size of homes built in the last couple decades is like almost twice as big as the average home that was built in the, you know, 30s, 40s, and 50s. So there's a reason. There's another reason homes are so expensive, not just inflation and low interest rates. So it's an interesting topic to try to unpeel a little bit.
Well, I think it's like resizing people's expectations, right? And when I first started, I was in a very small condo. When I first started home ownership, it was maybe 700, 800 square feet. It was two bedrooms. My cousin and I lived in a very small place. We actually got it as a foreclosure, right? So, resizing expectations to start small, but then, I call it springboarding, right? You get in something, you start to build some equity. You get, maybe when you sell it, you get a little bump there. You move into something that's maybe a little bit bigger, but also maybe not as big as you want. And then again, you start to build equity in that. And that those two things, building, being in a home and being in a retirement plan, those two things set people up for financial freedom, right? For the ability to call your own shots. And I would start with home ownership first, but it's so dang hard to get anybody into a home. And I don't know enough about it to actually help them do it, except connect with the right people, right? So 401k first, but then after that, try to get in a home.
Yep.
If you can, try to own your own home. Start small and build on that.
Good advice, Charles. I really appreciate you taking the time, the last
Yes.
45, 50 minutes to explain all this stuff. Hopefully listeners have learned something. We got a refresher on things they may have learned about a decade ago and hadn't thought about much since. So I really appreciate your time. I wish you the best of luck with FTG squared and growing that and
Thank you.
achieving your goals. And if folks want to
Absolutely.
get in touch with you, what's the best way for them to get in touch with you?
Best way is just to give me a call. I don't know. Do I put it in the chat here or something?
Just tell me what it is and I'll get it into the show notes and it'll be in the transcript.
Yeah, it's 301-466-9945. If you call me, I'll call you back. That's my promise.
All
So
right.
I know a lot of people don't always call you back. I do call people back. In fact, I made it one of the reasons I had such a good career is I would somebody would call me from some random number. I didn't even know who it was. I'd call them back. Half the time it'd be somebody looking they needed help, right? So I will call you back if you give me a call, and happy to do so.
Well, awesome. Thanks again, Charles, for your time today. I appreciate it.
Thank you, Cal.
This has been
Appreciate
another
it.
exciting episode of the Empowering Healthy Business podcast. Until next time, signing off.
Thank you.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.